Today's Wall Street Journal. We're breaking down the biggest business stories of the day, what happened, why it matters, and where the incentives really are. First article from journal Bowman softens bank oversight at Fed after the global financial crisis. A man named Daniel Tarullo was appointed to lead that effort. He spent years building a regulatory framework designed to identify emerging risks, to pressure banks when those risks materialized, and to prevent another 2008. 17 years later, a woman named Michelle Bowman, appointed to the Fed during Trump's first term, is systematically dismantling Tarullo's framework. And she's making it very clear to everyone inside the Federal Reserve that if you resist, there will be consequences. Tarullo, reflecting on what's happening now, said something devastating. He said, "They start to figure out that people who push a little bit harder on the banks, they get reprimanded. They don't get promoted. This is a capital allocation story. This is a story about systemic risk. This is a story about how institutions decay from the inside when leadership decides that inconvenient regulators need to be purged. And this is a story about how the most dangerous financial crises are the ones that nobody is prepared for, because nobody is allowed to be prepared." Let me set the stage. In September, Michelle Bowman, the Fed's vice chair for supervision, met with the top officials from the Fed's 12 regional districts. Bowman was appointed by Trump to oversee banking supervision. Her mission: roll back what she and many in the Trump administration view as the regulatory excesses that followed the 2008-22-9 financial crisis. At that meeting, Bowman delivered a message. She made clear that, notwithstanding the Fed's sometimes opaque chain of command, she was in charge and expected examiners to get on board. Some of those present left unhappy with the message and what they took as a dressing down. That was the opening shot. That was Bowman signaling to everyone: if you want to push hard on banks, if you want to enforce the rules, you will be removed. Here's what's important to understand. The staff of the Fed's quasi-independent regional banks are the ones who conduct most of its banking exams. They ensure the nation's financial institutions are stable. They're the ones who go into bank boardrooms and say, your risk management is inadequate. Your capital positions are too low. Your lending practices are reckless. That's not a popular thing to say to a bank CEO. That's not a popular thing to say in an environment where bank CEOs have the ear of the Treasury Secretary, the ear of the President, the ear of the Fed's leadership. So when Bowman signals that examiners who push hard will be sidelined, when she signals that being tough on banks is career death, what happens? Examiners stop being tough. They start being accommodating. They start being focused on, as Bowman says, less procedural and documentation shortcomings and more on what? Nothing. They just stop pushing. And that creates a vacuum. That creates a system where risks accumulate but nobody detects them until it's too late. Now let me tell you what Bowman has actually done. She has slashed staff. She has pursued what many inside and outside the central bank view as a house cleaning of the Supervision and Regulation Division's senior leadership. She ordered some senior officers to halt work and subsequently excluded them from meetings. Some have since left the Fed. She's now seeking a 30% reduction to the broader division staff. That's not efficiency. That's institutional gutting. In public speeches, Bowman has criticized the Fed's examiners for focusing too much on procedural and documentation shortcomings and not enough on a bank's core financial risks. She says reforms will make the process more efficient and lead to improved risk spotting. But that's not what's happening. That's the stated goal. The actual result is that people who spot risk are being driven out, and people who don't spot risk are being promoted. Internally, some examiners have interpreted her policies to mean they should refrain from being tough on the banks they oversee. In recent months, some examiners were sidelined or taken off the job by their supervisors after banks lodged complaints with Bowman. Let me repeat that. Banks complained to Bowman that examiners were being too tough, so Bowman removed those examiners. That's regulatory capture. That's the captured regulator working for the regulated firms instead of for the public interest. And it's happening at the Federal Reserve in real time, right now. Bowman has hired an outside consultant, Starling Trust Sciences, to conduct a fresh review of the 2023 failure of Silicon Valley Bank. Bowman has called an internal postmortem that Michael Barr conducted inadequate. That's interesting. Barr was Bowman's predecessor. Barr was tasked with preventing another Silicon Valley bank. He failed. Bowman seems to be arguing that his failure wasn't rigorous enough. But here's what I think is actually happening. Bowman is clearing the field of people who believe in strong banking regulation. She's clearing out the people who understand the lessons of 2008. She's clearing out the people who might resist when the next crisis builds. Bowman's background is instructive. She comes from Kansas. She worked at a small-town bank. She worked in compliance. She shoveled snow when the job required. She's sympathetic to community banks. Her family owns a farm and a ranch and a small-town bank. That's a perspective. That's not necessarily wrong, but it's a perspective that was underrepresented in the Fed's regulatory leadership because it had been the subject of intense debate after 2008. The consensus from that debate was, we need strong supervision. We need to catch risks early. We need to be tough on banks. Bowman is now reopening that debate. She's saying that consensus was excessive. She's saying that community banks are overregulated. She's saying that the system is in a straitjacket. And she's backing that up by removing everyone who disagrees. Treasury Secretary Scott Bessent, in an interview where he helped recruit Bowman to the Fed, said, "We have to take the financial system out of this straitjacket." That's the narrative. That's the ideological justification. The financial system is being constrained by excessive regulation. We need to loosen it. We need to let banks take more risks. We need to remove the regulators who are preventing that. But here's what most people miss. The straitjacket isn't there to constrain normal activity. It's there to prevent catastrophic failures. It's there because 2008 happened. It's there because Silicon Valley Bank happened in 2002-03. It's there because the system breaks when risks accumulate silently and nobody catches them until contagion spreads. And now we're removing the people who catch the risks. Bowman is also relying on an inner circle that includes a longtime banking lawyer and an economist with experience working for the Fed, as well as a trade group for the nation's largest banks. A trade group, an industry advocate, is helping reshape the Federal Reserve's Supervision and Regulation Division. That's not a conflict of interest. That's an explicit alignment of interests. That's a regulator working with industry insiders to reshape regulation in industry's favor. Let me extract the lessons because there's something fundamental here about institutional decay and how systems fail not with a bang but with a whimper. First lesson: regulatory capture doesn't require conspiracy. It doesn't require secret meetings. It requires someone in power who genuinely believes that the regulated industry is overregulated and that removing constraints will make the system healthier. Bowman may sincerely believe that, but the effect is the same. Regulation weakens, risk accumulates. Crisis is deferred but not prevented. Second lesson: the most dangerous regulators are the ones who believe strongly in the ideology they're imposing. Daniel Tarullo was appointed after 2008 to build regulation designed to prevent the next crisis. He was constrained by his ideology, crisis prevention. Bowman is now appointed to dismantle that regulation. She's constrained by her ideology, deregulation. Both are true believers. Both are dangerous in different ways. Third lesson: systems fail silently. The Federal Reserve isn't going to announce that it's weakening banking supervision. It's not going to publish a press release saying, starting next month, we're removing regulators who are too tough on banks. Instead, it happens through individual decisions. An examiner is sidelined. A senior officer is told to halt work. A deputy director is reassigned. The system gradually hollows out until the next crisis hits and nobody is prepared. Here's what I think is actually happening at the Federal Reserve right now. An ideological faction has taken control. They've decided that the regulatory regime that followed 2008 was excessive. They're systematically removing people who believe in strong supervision. They're elevating people who are sympathetic to the industry. They're eliminating the career consequences for examiners who are soft on banks. And they're doing it in the name of efficiency and competence and removing procedural and documentation shortcomings. But what they're actually doing is removing the system's ability to detect emerging risks before those risks become systemic. Some former Fed officials have expressed concerns about a hollowing out of the regulator and whether the Fed will be in position to identify emerging risks before they become systemic. Those officials should be listened to. They've seen this movie before. Here's what I'll leave you with. The Federal Reserve was designed to be independent. It was designed to be insulated from political pressure precisely because banking regulation sometimes requires unpopular decisions. It sometimes requires saying no to banks. It sometimes requires being tough even when the industry complains. Michelle Bowman is testing how far she can go in dismantling that independence. She's testing whether she can remove inconvenient regulators and replace them with industry-friendly ones. She's testing whether ideological alignment with the Trump administration can override the institutional norms that have protected Fed independence for decades. And so far, she's getting away with it. When weak regulators succeed in removing strong ones, you don't get a better system. You get a system that breaks quietly until the crisis hits. And by then, nobody is prepared. Moving to next title, how to get a bigger tax refund this year under the new rules. You know what interests me most about tax policy? It's not the tax rates. It's the systems that fail. The silent, invisible machinery that breaks when the law changes but nobody bothers updating it. Here's the opening insight. Americans are about to receive an average of $1,000 more in tax refunds this year. Some will get $10,000 more. That's not because the government is being generous. It's because the system that tells employers how much to withhold from your paycheck wasn't updated when the law changed. Nobody updated the withholding tables for 2025. The IRS has new rules. The W-4 stayed frozen. That's a $1 billion misalignment between policy intent and actual payroll mechanics. This is a capital allocation problem disguised as a tax story. Let me explain what I mean. Most people think tax refunds are normal. They expect to get money back. But think about this from first principles. Why would you want to give the government an interest-free loan all year and then wait months to get it back? Joseph Perry, the national tax leader at CBiz, actually puts it perfectly. You could say, I'm a bad saver. I'll get a bigger refund. Or say, I don't want the government to have the use of my money. I'd rather put it in the bank and earn interest on it. That's a choice about time and optionality. And it's a choice most people never consciously make because the system is designed to default them into overpayment. The central figure here isn't a person. It's a decision architecture, the IRS withholding system. For decades, it worked because it was simple. Employers used static tables, most people overpaid, most people expected refunds, and the system was accurate enough. It was good enough. But good enough broke the moment tax law became a moving target last summer. Summer 2025, Congress passed major tax law changes. Some provisions went retroactive to 2025. New deductions appeared. The SALT deduction cap went from $10,000 to $40,000. There's a new $6,000 senior deduction. There are deductions for tips, overtime pay, car loan interest. Child tax credits increased by $200. And something completely new. Trump accounts for children. $1,000 government contributions starting in 2025. Here's what happened. The law changed, but the withholding tables employers use didn't change for 2025. The system operates on inertia. Payroll departments across America kept using the old math. Employees didn't update their W-4s because most people don't update their W-4s unless they get a new job or have a major life event. The IRS knew this. That's why, for 2026, they updated the withholding tables proactively. But even then, it's on you to file a new W-4. This is the inflection point. For 2025, you get bigger refunds because the withholding was wrong. For 2026, the withholding tables are corrected, but only if you take action. Think about the incentive structure here. The IRS hasn't told most Americans to update their withholding. Your employer probably hasn't sent you a note. You're supposed to figure this out yourself, and most people won't. Andy Phillips, vice president of H&R Block's Tax Institute, has the right diagnosis. Anytime people have big life changes or there are law changes, people can miss benefits they're entitled to. People miss them. They just miss them. The system doesn't push it. The information isn't front and center. So what happens? You get a $1,000 to $10,000 refund you didn't expect, you feel good about it for a moment, and then next year you do the same thing all over again. Let me make this concrete. Piper Sandler did a study. The average refund this year is expected to be $1,000 higher than the $3,167 average from last year. Some taxpayers, especially upper-middle income people with high state and local taxes, could get refunds of $10,000 or more. Now imagine you're getting an extra $10,000 refund. That money came from your paychecks throughout 2025. You could have had $450 more twice a month, $900 a month. That's real money. That compounds. That could have been in a bank account, earning 4% interest. Instead, it was in a government account earning 0, waiting for you to file a tax return months later. Here's the calculus. If you file electronically with direct deposit, the IRS says you'll get your refund within 21 days. If you don't elect direct deposit, it could take much longer. Some people are getting paper checks, and the IRS is phasing those out anyway. They're moving to electronic-only refunds following an executive order. But that wait time is real. Your money is gone. You're waiting. You could have had it the whole time. What's the damage? Let me read you the numbers from the chart the Wall Street Journal provided. They broke down how much tax revenue the government is losing from each new provision. The overtime pay deduction costs $38.7 billion annually. The SALT deduction increase costs $32.2 billion. The standard deduction increase costs $18.3 billion. The senior deduction costs $16.8 billion. Overtime pay, tips, car loan interest, child tax credits, each piece moves the needle. This is real fiscal impact. The government knew the cost. They changed the law anyway. But the withholding machinery stayed frozen. Now let's talk about what people are actually going to do with the deductions they now qualify for. This is where capital allocation gets interesting. The standard deduction went up by $750 for single filers and $1,500 for joint filers. That's the automatic break if you don't itemize. But here's the thing. For nearly 90% of taxpayers, taking the standard deduction is still the best move. But not for everyone. If you live in a high-tax state, suddenly your story changes. The SALT deduction cap went from $10,000 to $40,000. That's a $30,000 swing. If you're in California, or New York, or New Jersey, paying high property taxes and high income taxes, you might now be better off itemizing instead of taking the standard deduction. The fine print. The SALT deduction starts phasing out once your modified adjusted gross income hits $500,000. And it phases out steep, very steep, like really high marginal tax rates steep. But that's a problem for 0.1% of people. For most people, $40,000 of SALT deduction is a massive gift. If you're 65 or older, there's a new senior deduction of $6,000. This is separate from the additional standard deduction you already get. So, a married couple, both over 65, filing jointly, can claim an additional $4,000 from the extra standard deduction plus $12,000 from the new senior deduction. That's $16,000 more in deductions. Trump talks about this as no tax on Social Security, but technically a $6,000 deduction isn't enough to eliminate Social Security taxation for everyone. But it helps. It's a meaningful help. There's a new deduction for tips income, up to $25,000. Most people won't get this. Tax drivers, bartenders, restaurant workers, occupations the Treasury Department specifies. Your employer probably won't report this on your W-2. You have to track it yourself. Phase-out starts at $150,000 for single filers. There's a deduction for overtime pay, $12,500 for a single return, $25,000 for joint. Here's the specific language. It's the half of time and a half pay required by the Fair Labor Standards Act. That's oddly specific. Your employer might report it separately. Phase-out starts at $150,000 single, $300,000 joint. There's a deduction for auto loan interest, $10,000 per return, only for new vehicles. Only if final assembly occurred in the U.S. phase-out at $100,000 for single, $200,000 for joint. All of these deductions have phase-outs. All of them have income limits. All of them have fine print. And most of them don't show up on your W-2. You have to track them yourself and report them on your return. This is where I want to pause and think about capital allocation incentives at work. Why doesn't the IRS just update the withholding system automatically? Why doesn't your employer send you a note? Why is it on you to figure this out? The answer is structural inertia meets political incentives. The withholding tables are bureaucratic. Changing them requires coordination across the IRS and payroll software vendors and employers of all sizes. That's coordination cost. It's easier to keep the old tables and let people overpay than give them refunds later. It shifts the burden from the system onto the individual. And here's the kicker. The government keeps your money interest-free for months. That's a working capital benefit to the Treasury. The cost of floating overdue refunds is real, but the government bears it, not you. So there's no structural incentive to fix the system. The cost is diffuse. The benefit to the government is real. even if it's just 1 percentage point of GDP at work in the float. The people who lose are the ones who don't know to update their withholding. They're paying extra money all year and not getting it back until months later. The people who win are the ones who take action. Update the W-4, adjust your withholding to match your new liability, and keep more cash in hand now instead of waiting for a refund. But here's the tricky part. You have to update by 2026. For 2025, you already overpaid. You're getting a refund. That's done. But for 2026, the burden is on you. You have to file a new W-4. You have to do the work. You have to calculate your new deductions and enter them on the withholding worksheet. The IRS released an updated W-4 and worksheet for 2006 that includes everything: tips, overtime car loan interest, the senior deduction, the higher SALT cap, the new charitable donation changes. It's complex. It's like filling out a tax return, as the article says. For someone with a simple W-2, it's maybe 15 minutes. For someone with multiple income sources or itemized deductions, it could be an hour or more. And if you get it wrong, if you don't withhold enough, you face penalties. As of January 1st, the IRS is charging 7% interest on estimated tax underpayments. To avoid penalties, you need to pay in at least 90% of your current year tax bill or 100% of your previous year's bill. For people with AGI over $150,000, it's 110% of the previous year. This is the enforcement mechanism. It's there. It's real. It's 7% interest. That matters. Now, let me talk about the second order effects, the things people often miss. There's a new thing called Trump accounts. These are special individual retirement accounts for children born from 2025 through 2028. The government will contribute $1,000 to each account. Parents can open them and request the $1,000 at tax time using a new Form 4547. Or they can go to trumpaccounts.gov starting mid-2026. It's a long-term savings vehicle for children. Philanthropists or local governments might also use these accounts to distribute money to children in your area. The fine print. The child needs a social security number. Must be a U.S. citizen to get the $1,000. If you're making the election in 2026, the child must be under 18 for the whole year. This is capital allocation thinking applied to children's savings. The government is seeding $1,000 into compounding vehicles. If that grows at 7% annually for 60 years, from birth to age 65, that $1,000 becomes roughly $135,000. Not life-changing, but real. And the fact that the government is doing it says something about the long-term compounding bet they're willing to make. Here's another thing most people miss. The child tax credit increased by $200 to $2,200 per child. That phases out at $200,000 for single filers, $400,000 for joint filers. Most middle-class families with children qualify for the full credit. If you have 3 kids, that's $6,600 in credits. This is real money flowing to families. It's not a deduction. It's a credit. A credit reduces the amount of tax you owe, not the amount of income that's taxable. So for a family paying an effective tax rate of 22%, $6,600 in credits is worth about $3,000 in saved taxes, plus the full $6,600 in credit value. Pure, dollar-for-dollar reduction in liability. Now here's the reality check that most people don't want to confront. State income taxes won't benefit from most of these new federal deductions. California doesn't have its own version of the senior deduction. It doesn't have deductions for tips, overtime, or car loan interest. So if you live in a high-tax state, you get the federal break, but not the state break. That's a compliance burden. You have to calculate different numbers for federal and state returns. You have to track what applies where. For high-income earners in places like California, this is a trap. The federal deductions are real. But on your California return, you're still calculating under the old rules. Your effective tax burden isn't as much better as the headlines suggest. The other reality check: brokers now have to report digital asset sales using a new Form 1099, DA. This is the first year. Crypto sales, NFT sales, any digital asset transaction, your broker has to report it to the IRS. But here's the catch. Brokers aren't required to report the cost basis, what you paid for the asset when you bought it. So you can get a 1099 DA showing you sold an asset for $50,000, but the IRS doesn't have the record of what you paid for it. That leaves it to you to calculate your capital gains tax liability. It's a reporting gap. It's a compliance burden. Starting in 2026, brokers will report cost basis. But for now, it's on you. This is a capital allocation problem dressed up as a reporting requirement. If the IRS has incomplete data, compliance becomes harder, audits become more likely, and the burden of proof shifts to you. And let me trace through the incentive problem one more time, because this is where the whole story coheres. The system is designed to favor passive compliance. If you don't do anything, you'll get a bigger refund. That feels good. You feel like you won, but you didn't win. You loaned the government your money interest-free. The system is designed to make you okay with that by making the refund feel like a surprise gift when it's actually your own money coming back to you. The people who understand capital allocation, who understand that money in hand now is worth more than money later, are the ones who update their W-4s. They're the ones who adjust withholding to match their true liability. They keep more cash in hand throughout the year. They can invest it, they can use it. They have optionality. Everyone else, the vast majority, will get the refund and feel good about it. They'll file their 2026 returns the same way. They'll overpay again. They'll get another refund in 2027. This is a system of inertia. And inertia, over time, extracts a cost. Let me synthesize 3 timeless lessons from this. First, systems default you toward their convenience, not yours. The withholding system is designed to be administratively simple for the IRS and employers. That simplicity comes at a cost to you, the cost of overpayment and float. The system changes when the law changes, but it doesn't update automatically. The burden shifts to the individual. Most individuals don't realize they have the option to adjust. Even the ones who do often don't, because it requires action. Incentives matter. Defaults matter. Most people operate within defaults. Second, new rules create temporary arbitrage opportunities for the informed. When the tax law changed, there was a gap between the new rules and the old withholding tables. That gap was an arbitrage opportunity. Pay less to the government now by taking deductions most people don't know exist, then file a corrected return later. But that arbitrage only works if you know about it. If you're not paying attention, you miss it. The information is public, but it's not pushed. That's how edge goes to the small percentage of people who read carefully, think about incentives, and act. Third, optionality and compounding have real, measurable economic value. If you're getting an extra $10,000 refund, that's $900 per month in liquidity you're giving up. Over a year, at 4% interest, that's $180 in opportunity cost. Over a decade, it's thousands. Over 40 years, it's tens of thousands. The future value of having money now instead of later is quantifiable. It compounds. Most people don't calculate this, so they don't feel the cost. But the cost is real. Here's my closing thought. Tax policy is often discussed as if it's about rates and brackets, but the real impact of tax policy is in the systems that implement it. The withholding system, for decades, was stable. The law didn't change. The tables didn't need updating. Everyone overpaid slightly, everyone got refunds, everyone was okay with it. Then the law changed. The system didn't adapt. That's when you realize systems have inertia. Policy has delay. And the individual bears the cost of that delay. The people who understood capital allocation, who understood that $1,000 now is worth more than $1,000 in 3 months, were the ones who updated their withholding. The rest of America will get bigger refunds and feel good about it, not realizing they just gave the government an interest-free loan for a year. This is what happens when law changes faster than systems evolve. Someone benefits from the gap. Someone pays for the gap. The question is always, which one are you? Moving to next title, Starbucks chief sets table for 26. Notice anything different at Starbucks these days? That's the question the company is betting your answer to determines whether they've finally fixed something that was deeply quietly broken. Let me set the stage. Brian Niccol became CEO of Starbucks in September of 2024. He came from Chipotle, where he was known as an operator, someone who cares obsessively about store-level execution. He cares about how food is prepared, how it's served, how the customer feels when they walk out. That's a fundamentally different leadership mindset than most restaurant CEOs, who think primarily about menu innovation or marketing or brand extension. What Nickel inherited at Starbucks was a company in a slow, imperceptible collapse. The chain ran around 10,000 U.S. locations, but that number was down about 400 from the prior summer. 400 stores closed, quietly, without much fanfare. The press coverage didn't hammer this. Investors didn't panic visibly. But here's what that signals: a company that was retreating, not growing, not expanding, contracting. And the contraction happened under the radar, which means management wasn't confident enough to say it publicly. At the same time, the chain's core profitability last year fell to some of the lowest levels since the pandemic. That's the quote from the Wall Street Journal. Think about that for a moment. The pandemic was 2020 and 2021. Starbucks is back to pandemic-era profit margins. Not revenue, profit margins. That means expenses were exploding relative to revenue. Same-store sales flat or declining. Stores closing. Margins compressed. This is what happens when an operator walks into a company where operators stopped operating. Nickel spent his first full calendar year, 2025, plowing millions of dollars into a very specific kind of capital allocation. Not new marketing campaigns, not menu innovation, not store expansion. Instead, barista training, ceramic mugs, replacing faulty power outlets. He rewrote the guidebook for greeting and serving customers. He restricted cafe bathrooms to paying customers. He turned condiment bars off to the public. He closed hundreds of locations. This is not a typical CEO playbook. Most retail leaders in a tough environment would do the opposite. They'd push new products, they'd expand the menu, they'd launch a flashy marketing campaign. They'd try to drive top-line revenue growth to hide the margin compression. Nickel did the opposite. He squeezed. He tightened. He focused on the fundamentals of operating a coffee shop, training baristas so they can serve customers faster and with better quality, installing ceramic mugs instead of paper cups so the experience feels better, replacing broken outlets so customers can work in the store, rewriting the greeting protocol so customers feel seen and valued, closing stores that weren't working. And here's the thing: the core profitability fell to pandemic lows while he did this. Margins compressed further. The business got worse before it got better. That's what real operational turnarounds look like. They're painful. They require spending money up front without immediate revenue offset. You retrain people. You rebuild culture. You fix what's broken at the store level. And your financials get worse before they improve. But then something happened. In November, during the holiday promotions, Starbucks posted record sales days. Not record for the month, record days. New products started helping attract customers. The brand momentum shifted. Now look at what's happening to the stock. Starbucks shares are up around 16% so far this month. The S&P 500 restaurant subindex is up 4%. Starbucks is outpacing by a factor of 4. That's not noise. That's not cyclical. That's conviction that something changed. On screen, you're seeing a chart showing Starbucks share performance since Nickel took over in September 2024. The line drops through the fall and winter. That's the pain phase. The margins compressing. The market worried. The stock declines. Then, starting in November, the line inflects upward. The momentum accelerates. This month, it shoots up 16%. That's a classic operator-led turnaround pattern. Spend first. Fix what's broken. Document the pain in the numbers. Market gets nervous. Then suddenly, once the foundation is rebuilt, the top line catches. The market sees it. The stock moves. Here's what's happening. Nickel is plowing millions into store-level operations. Training, fixing outlets, improving service. But the people executing those operations are in the middle of labor negotiation. Some are striking, some stores are closing. This is a classic conflict between capital allocation and labor dynamics. You can invest in the experience. You can fix the store. But if the people running the store are in conflict with management, the experience suffers. Morale is fractured. Service quality declines precisely when you're trying to improve it. The strikes are a hidden tax on the turnaround. They cost money directly, lost sales during closure periods. But they also cost morale, consistency, and the ability to execute the training and culture work that Nickel is trying to build. Now here's what Nickel is planning next. He wants to expand the U.S. footprint again. He's closed 400 stores. Now he wants to grow them back. To do that, Starbucks is testing a new cafe design, smaller and cheaper to build. This is operational thinking. Not let's make a fancier store, or let's create an experience center. Instead, How do we build more stores faster and cheaper? How do we scale the unit economics? He also wants to install more comfortable seating at hundreds of U.S. locations. He wants to make it simpler to pick up drinks. He wants the chain to keep food better in stock. He wants superior customer service. And he thinks the messages written on cups can be meaningful too. That last phrase is interesting. It's marketing adjacent, but it's really about connection. The cups are a touch point. If they're meaningful, if they're personal, it's a signal that we see you. We know why you're here. We care about more than just the transaction. This is a founder-level operator thinking about store-level experience. It's obsessive. It's small. It's not about scale or efficiency in the traditional sense. It's about the quality of the moment when a customer walks in, orders, waits, receives their drink, and leaves. But here's the investor question. How does his strategy translate into growth? Starbucks has had a long stretch of stagnant sales. That's the reality behind the margin compression. The profit margins fell not because costs exploded, but because revenue stagnated. Same stores weren't growing. They were flat or declining. More stores were needed to drive overall growth. But instead, Nickel closed 400 of them. So the question is, are the new stores he's planning to open going to be fundamentally different? Is the new design cheaper and faster to build? Are the unit economics better? Or is he just rebuilding what he closed? If it's the former, he's solving the problem. If it's the latter, he's just resetting to zero. The article doesn't tell us which one it is, but the fact that he's testing a new design suggests he's not just rebuilding. He's trying to change the model. Now let me talk about what people are missing when they read this story. The stock is up 16% in 1 month. That's fast. That's enthusiasm. The market is pricing in the belief that Nickel is fixing Starbucks. But here's the gap. We haven't seen sustained revenue growth yet. We've seen record sales days in November. We've seen new products helping attract customers. But sustained growth? Margin expansion? We're still waiting to see it. The labor strikes are ongoing, at least in limited form. That's a constraint that could reverse the momentum if it escalates. Nickel can improve the store experience, but if strikes intensify, if closures increase, the story breaks. The 400-store contraction that already happened was painful, but it's gone. That's sunk cost. Now the question is whether the remaining 10,000 stores are actually better than they were before or just less crowded. And here's the deepest insight. Nickel is betting that operators matter more than everything else. That training people, fixing bathrooms, replacing outlets, rewriting protocols, that all of that moves the needle more than new menu items, more than marketing, more than any other lever most retailers would pull. He's betting that Starbucks was broken not because of the market or competition or consumer demand. It was broken because the store-level experience had degraded. People walked in, bathrooms were closed, seating was uncomfortable, outlets didn't work, baristas seemed rushed. The experience felt transactional. He's fixing that. And he's betting the market will reward him for it. The fact that November saw record sales days suggests he's right. But it's 1 month of data. The momentum has to persist. The strikes have to stay contained. The new stores have to launch and work. The margins have to expand, not just the revenue. Let me distill 3 timeless lessons from what's happening at Starbucks. First, when a mature business starts contracting its footprint, it's not cost optimization, it's a signal of operational breakdown. A healthy restaurant chain grows by opening more units. When it closes hundreds of stores without explanation, it's because those stores aren't working. The economics are broken. The management has given up on fixing them. Nickel inherited that wreckage. The fact that he closed them is a reset. The fact that he's now planning to reopen stores tells you he believes the operational foundation is fixed. That's the true inflection. Second, store-level operations is a lever most retail leaders ignore because it's granular, it's unglamorous, and it doesn't show up in splashy press releases. New menu items are announced with fanfare. Marketing campaigns are showy. But training people to greet customers better? Replacing power outlets? That's invisible to everyone except the people actually in the stores. It's also the most powerful lever a good operator has. Nickel knows this. His first year was entirely spent on these invisible things. The stock market is starting to believe him. Third, margin expansion comes from fixing the fundamentals of your business model, not from raising prices or cutting costs at the corporate level. When Starbucks margins compressed, the instinct is to squeeze costs, lay off corporate staff, reduce spending, slow the organization. Nickel did the opposite. He spent millions on training and store improvements. He believed that fixing the fundamental operation would expand margins by improving the unit economics. November's record sales days suggest he's right. More customers are coming back. Average transaction value probably increased. The store is busier. The margins improve because the operation is better, not because you cut somewhere else. Here's my final thought. Brian Nickel is an operator. He thinks about stores the way a surgeon thinks about patients. He observes what's broken. He diagnoses the problem. He performs the repair. He checks the results. Then he scales what worked. Starbucks was broken. Not strategically, not from the outside. Operationally, from the inside. Store by store, he's fixing it. The early results are there. The momentum is there. But the real test isn't whether November was a good month. It's whether Starbucks can sustain this, expand the footprint, keep the labor situation contained, and prove that fixing store-level operations is more important than any other capital allocation decision a retail CEO can make. The message that will echo for years is this: a great operator can fix a broken thing faster than most people think possible, but only if they're willing to spend money up front on the fundamentals that everyone else ignores. Moving to next title, Co-work market rebounds. Rob Spire, the CEO of Tishman Speyer, said something in 2019 that nobody has forgotten. He said co-working may be the biggest disruption to real estate since the invention of the elevator. Think about that claim, the elevator. Vertical office buildings became economically feasible because of elevators. Co-working was going to be that transformative. It wasn't. Not then. Not the way he imagined. What happened instead is instructive for everyone who pays attention to how capital allocation failures unfold. The co-working boom became the co-working bust, and then, slowly, quietly, the co-working market is coming back. But it's coming back completely different. The winners are different. The economics are different. The entire structure of the industry got reorganized by a single inflection point, the pandemic. Here's what you need to understand about the original co-working story. It started in the late 2000s, when startups and freelancers needed alternatives to expensive, long-term office leases. They wanted flexibility. They wanted to pay month to month. They wanted community. Co-working spaces offered that. It was genuinely useful for a real problem. As the model expanded through the 2010s, real estate executives got excited. They smelled a megatrend. And they were right that something was shifting, but they misunderstood what that something was. They thought it was a growth opportunity. They thought they had found the next S-curve. Enter WeWork. Adam Neumann's company became the symbol of the model. It was flamboyant. It was aggressive. It raised billions. It expanded globally. At its peak, WeWork occupied more Manhattan office space than any other single company. Let me say that again. More Manhattan office space than Google, Microsoft, JP Morgan. Anyone. A company that rented desks to freelancers and small firms was occupying more space than the world's largest tech and finance companies. But here's the problem. WeWork's expansion was fueled by three things that, when you add them together, create a recipe for disaster. Long-term lease obligations, heavy capital spending, and optimistic assumptions about demand. This is how you build fragility. This is how you create a company that looks invincible until it suddenly isn't. The long-term leases mean you're locked into paying rent for years, regardless of whether you have customers filling the space. The heavy capital spending means you're constantly building out new locations, renovating spaces, creating this beautiful brand experience. And the optimistic assumptions about demand mean you're betting that customers will keep coming faster than they historically have. This is a leverage triangle. Each leg makes the others more dangerous. You're betting that growth is permanent. You're betting that demand is inelastic. You're betting that you can outrun the market long enough to establish dominance before the market changes. Then the market changed. The pandemic hit. Everyone went home. Demand for office space, especially flexible office space, collapsed. WeWork went to bankruptcy in 2030. Now, here's what I want to focus on: the new co-working model that emerged from the wreckage. John Santora is WeWork's CEO now. He took over in 2024 when the company emerged from bankruptcy with Yardi as the controlling shareholder. And his philosophy is completely different from Neumann's. He said something that clarifies the entire situation. We're not going to take stuff that's going to choke you if it doesn't fill up right away. That's the opposite of Neumann's philosophy. That's the opposite of the 2019 Tishman-Speyer thesis. Santora is saying, we're going to be disciplined about real estate decisions. We're going to take smaller spaces. We're going to share risk with building owners. We're not going to bet the company on optimistic assumptions about occupancy and growth rates. This is what survivor CEOs sound like. People who've lived through a collapse and emerged knowing what actually matters. Now let me show you what's happening on screen. You're seeing a chart of co-working space in the United States. This is critical. The vertical axis is space in millions of square feet. The horizontal axis is time. January of 2023, 2024, 2025, 2026. There's a second scale showing the number of locations. What you're looking at is the recovery from the pandemic low. In January 2023, co-working was at around 115.6 million square feet, across about 5,800 locations. By January 2026, it's at 158.3 million square feet, across 8,772 locations. Let me explain what that means. Space grew 37% in 3 years. Locations grew 51% in 3 years. Locations are growing faster than square footage, which means average location size is shrinking. Smaller spaces, more locations, decentralized. This is a massive shift. You're not seeing a return of the old WeWork mega campus model. You're seeing fragmentation. What's driving this growth? 4 key things. First, companies need flexibility. They're downsizing from the old corporate headquarters model. They want satellite offices closer to where employees live. They need short-term leases so they can adjust as their workforce evolves. The pandemic proved that remote work is viable. Companies don't need everyone in one tower anymore. Second, larger companies are now using co-working for satellite offices. Pfizer, Amazon, JP Morgan Chase, Lyft, Anthropic. These are major corporations using co-working space. That's not how the market worked in 2015. Back then, co-working was for startups and freelancers. Now it's a tool that multinational corporations use. Third, the experience matters more than ever. Jamie Hodari is the co-founder of Industrious, and now a top executive at CBRE. He said something important. Remote workers are livid about it if you force them back to the office, and it's a crappy experience. This is a constraint on capital allocation. You can't just put people in a basement with folding tables anymore. You have to offer the same amenities as corporate headquarters, collaboration spaces, mentoring areas, good food and beverage service. The cost floor for a usable co-working space has risen. That changes the math for everyone. Fourth, the distribution of supply has shifted. Industrious, which is part of CBRE, added more than 50 locations last year, for a total of over 250 in the US and Europe. That's growth. But here's the more interesting point. Single-site operators have grown 66% in the past 3 years to over 3,500 locations. That's growing at double the rate of the top 20 operators. The market structure is inverting. Instead of WeWork creating one giant network with centralized control, you're getting thousands of independent operators. Small companies, local expertise, risk distributed. Let me give you a concrete example. Onionland Development converted a former truck parts warehouse in Buffalo, New York, 6 years ago into Hansa Workspace. 32,000 square feet. A converted warehouse in Buffalo. This is not a glamorous flagship location. This is the real estate on the edge of the map. Onionland initially expected demand to come from growing companies seeking additional office space. That was their hypothesis. They were thinking like the old co-working guys. Small firms need more room. Let's give them space. Instead, they discovered that most of their larger tenants were firms downsizing from traditional offices. They were moving into flexible space to accommodate remote work. The business you think you're building is not the business you end up building. This is true across all capital allocation decisions. You have a thesis. You execute against that thesis. The market reveals something different. Erin Fontenot is Hans's community manager. She captured it perfectly. It's predominantly folks that are downsizing from traditional offices. Now let me turn to what's happening with the big operators. CBRE acquired a controlling stake in Industrious. This gave Industrious access to a long roster of corporate tenants and building owners connected to CBRE, the world's largest commercial real estate services firm. Scale meeting scale. But notice what Industrious is doing with that access. They're not opening 100 mega campuses, they're opening small satellite offices. Often fewer than 100 employees. The pitch to corporations is simple. You can have an office close to where your people live. You get the benefits of in-office work, collaboration, mentoring, access to amenities, without the commute burden. Before the remote work era, corporations could put workers in satellite space with little more than basic desks, conference rooms, break areas. Minimal common space, minimal food and beverage service. You got what you got. Now, remote workers feel like they've been punished if the experience is poor. The expectation has risen. They've worked from home. They've had flexibility. You can't put them back in a mediocre space and expect them to be grateful. The company has to invest in the experience. This is where I want to pause and think about what the market is really telling you. The co-working industry is coming back. But it's coming back as something completely different from what it was in 2019. The economics are more constrained. The risks are more distributed. The winners are going to be operators, not growth-at-all-costs expanders. Currently, co-working accounts for 2.2% of U.S. office stock. That's up from 1.7% 3 years ago. Yardi predicts it could eventually reach 10%. Think about that trajectory. We're at 2.2%. The ceiling could be 10%. That's a 4 to 5 times expansion opportunity from current levels. But here's the catch. It's only going to happen if individual locations are profitable. It's only going to happen if operators figure out how to run the economics without betting the company on perpetual growth. It's only going to happen if you stop thinking like Adam Neumann and start thinking like John Santora. But here's what most people miss. This is below the pre-pandemic peak. Before the pandemic, co-working space was even larger. So we're not at a new all-time high. We're in recovery, but we're still not back to where we were at the market top. That's actually a positive signal. It means this isn't irrational exuberance. It means the growth is being driven by genuine demand. Corporations wanting satellite offices, companies seeking flexibility, not by speculative capital flooding into a hot sector. It's being built more carefully. It's being built with discipline. Here's what investors need to understand. The next wave of co-working is not going to be a venture capital story or a real estate speculation story. It's going to be an operational competence story. The winners will be companies that can run profitable individual locations, that understand how to manage the experience, that understand their local markets. Single-site operators growing at 66% in 3 years. That's the signal. That's where the value is going. Now let me extract 3 timeless lessons from what's happened to co-working. First, scale can become a liability if it's built on assumptions that don't hold. WeWork scaled aggressively because it believed demand was infinite and growth was permanent. It took long-term leases and committed to heavy spending based on that assumption. When demand changed, suddenly, dramatically, scale became a trap. You can't shrink a company built for growth quickly enough. You can't renegotiate leases. You can't walk away from capital commitments. The bigger you've built, the more pain you feel when the market shifts. This is why disciplined expansion matters more than maximum expansion. Second, industry disruption often comes not from winning at the old game, but from changing the rules. Rob Spire said co-working would be the biggest disruption since the elevator. He wasn't wrong about the transformation, but he was wrong about who would win. The old real estate CEOs thought they'd dominate. Instead, single-site operators with local expertise are growing twice as fast as the big players. The disruption happened, but it redistributed power to a different part of the market structure. The winners are not the obvious incumbents. Third, the quality of your customers matters more than the quantity. WeWork wanted to maximize occupancy and expansion. The new model is disciplined about who it serves and what it charges. It's accepting smaller locations because it understands that 80% occupancy in a small space beats 40% occupancy in a massive one. It's investing in experience because remote workers have options and expectations. It's willing to share risk with landlords because it knows the old model, passing all risk to the operator, doesn't work. This is the difference between scaling a business and building a business that scales sustainably. Here's my closing conviction. Co-working is coming back, but the co-working that comes back will look nothing like WeWork at its peak. It will be smaller, more local, more disciplined, more profitable, and more boring to venture capitalists. It will be exactly what the market needs. flexible workspace run by operators who understand their locations and their customers. The frothy speculation is over. The real business is just beginning. The sentence you'll remember years from now is this: the biggest disruption to real estate since the elevator wasn't WeWork. It was the discipline that WeWork's collapse forced the industry to adopt. Moving to next title, First Brands shuts businesses. Watch how fast a company can unravel when the foundation was never real. First Brands, a North American auto parts supplier, filed for Chapter 11 bankruptcy in September. That's important context. September, 4 months ago. The company came into bankruptcy with what looked like a reasonable path forward. They'd get a debtor-in-possession loan, a DIP loan, that would keep them operating while they tried to sell their assets or reorganize. Standard bankruptcy playbook. Happens all the time. The DIP loan was for $1.1 billion. That's not small money. That's real capital. That's supposed to buy you runway. That's supposed to buy you time to fix what's broken or sell the pieces. Except it didn't. The loan value dropped precipitously a month later. That's the quote. Not a month later, gradually. Precipitously. Like a stock crashing. What happened? Lenders became aware that First Brands' financial problems were worse than expected. That's the euphemism for the numbers that were given to us in September were false. This is where I want to pause and ask, how do sophisticated lenders, professionals at Oaktree Capital Management and Mudrick Capital Management, both experienced credit operators, get blindsided on the true financial condition of a company just 1 month after providing $1.1 billion? The answer is in the history. First Brands had sued its founder and former CEO, Patrick James. The allegations were that James diverted money from the business to fund his lifestyle. But before that was even the focal point, restructuring advisors discovered something else. The company had double-pledged receivables and made-up invoices to use as collateral. Let me translate that. The company created fake revenue, fake invoices, used those fake invoices as collateral to borrow money, then borrowed against the same collateral twice. That's not a mistake. That's not an accounting error. That's fraud. And the lenders didn't know about it until they were already committed with $1 billion check. This is a capital allocation failure of the first order. When you're a large credit fund and you put $1 billion into a DIP loan, you're supposed to have done due diligence. You're supposed to have looked at the books. You're supposed to have forensic accountants combing through the records. You're supposed to know what you're funding. But somehow, with $1 billion on the line, the lenders still got surprised. James has denied wrongdoing, but the company sued him anyway. That's not a normal relationship. That's a founder and CEO who was actively looting the business while simultaneously being in control of the accounting and the information flow to lenders and creditors. Now here's what happened next. Charles Moore is the interim CEO now. He made a statement. We explored all available options to secure funding and advance the sale process, but found no viable solution to keep these parts of the business going. Translation: nobody will lend us more money. We can't refinance. We can't bridge the gap to a sale. We're out of options. The company said it would run out of money by the end of January. We're in late January now, so this bankruptcy is reaching its terminal phase. The oxygen is being cut off. First Brands started winding down brake parts, an aftermarket parts maker called Cardone, and a spark plug manufacturer called Autolite. It's keeping operating the remaining businesses, filters, wipers, pumps, lighting, other accessories, as it seeks buyers. But here's what's happening. The major lenders, Oaktree and Mudrick, are exploring a partial liquidation of the company. That means they're not trying to preserve value. They're trying to extract whatever they can before everything goes to zero. And here's the kicker that tells you about the incentive structure. After some lines of business are shut down, the key lenders could choose to acquire the remaining assets using their debt as part of their offer. Translation: the lenders are going to take their $1 billion loss, use that debt as collateral for their own bid to acquire the remaining viable assets at fire sale prices. They're converting their failed loan into an acquisition vehicle. This is how you recover from a bad loan. You don't wait for the company to succeed. You convert the debt into equity. You use that equity as part of your bid for the assets, and you hope that buying the pieces for pennies on the dollar lets you rebuild something viable. But here's what I want you to understand about capital allocation. When the best outcome for the lenders is to liquidate the company and buy the pieces, that means the loan decision was fundamentally wrong. A good loan should have an outcome where the company survives and thrives and everyone gets repaid. If the best outcome is liquidation and debt-to-equity conversion and asset acquisition at distressed prices, the original capital allocation failed. The question is, why? Why did Oaktree and Mudrick, two of the most sophisticated credit investors in the world, put $1 billion into a company with doctored books? Why didn't they catch it? Why wasn't the fraud discovered before they committed the capital? The answer probably involves a combination of factors. The founder was actively controlling the information. The accounting was deliberately falsified. The DIP lenders probably trusted interim management or existing advisors who themselves didn't know or were complicit. The speed of bankruptcy moves fast. You often have to commit to capital before you've completed full forensics. And sometimes the fraud is sophisticated enough that even experienced professionals miss it. But the core problem is this. Patrick James built a house of cards while he was looting the company. He made invoices. He used fake receivables as collateral. He diverted cash. And by the time anyone figured it out, he'd already done the damage. The company filed in September with $1 billion DIP loan. By late January, they're out of runway and liquidating. That's about 4 months. 4 months for $1 billion company to go from "we'll solve this through bankruptcy" to "we're shutting down." That velocity of collapse tells you everything. When a company can burn through $1 billion in 4 months without finding a buyer or a path to reorganization, the original business model was probably not viable at scale. The economics were broken. The fraud just accelerated the inevitable. Now, here's the reality that nobody wants to confront about this situation. The lenders are not the villains here. They made a capital allocation mistake, but it's a mistake made with incomplete information in a fast-moving situation. They're professionals. They'll recover some portion of their $1 billion loss by buying the assets in liquidation. They'll lose money, but they'll get some recovery. The real villain is the founder. Patrick James built a company on fraudulent accounting. He diverted cash to fund his lifestyle. He used fake invoices as collateral. He put the company in a position where the only outcome is failure and liquidation. This is what destruction of value looks like. Not a bad market. Not poor execution, not competitive pressure, pure, intentional, deliberate fraud by the guy in charge. And here's the uncomfortable truth. Fraud at the founder level is hard to catch. The person has control of the accounting. They have control of what information gets reported to lenders and boards. They can hide it for years if they're careful. It's not like operational mistakes, which eventually show up in the numbers. Fraud is active deception. The only real defense is rigorous forensic accounting done by people who are specifically looking for fraud, not just errors. And that's expensive. That's time-consuming. That's not standard practice on every DIP loan. So Oaktree and Mudrick probably did what most sophisticated lenders do. They looked at the most recent audited financials. They looked at management projections. They looked at the business model and the market. They probably did some spot checking. But they probably didn't hire a forensic accounting firm to completely reconstruct the company's financials from the ground up. If they had, they might have caught the fraud. But that's not standard practice. Standard practice is to trust the prior auditors and the management team. And in this case, that trust was misplaced. Let me extract 3 timeless lessons from First Brand's collapse. First, founder control of accounting is a massive red flag, especially when the founder is under financial or lifestyle pressure. Patrick James had control of the company's financials. He made up invoices. He double-pledged receivables. He diverted cash. No system of internal controls caught it before the company filed for bankruptcy. This is a governance failure at the most basic level. If one person can fabricate revenue and use it as collateral, your controls are broken. The lenders should have been more skeptical. The board should have been more vigilant. Someone should have asked harder questions. The lesson is, when a founder has unchecked control of the accounting, you're taking on fraud risk, whether you know it or not. Second, capital allocation decisions need to be made with the assumption that not all information is truthful. Oaktree and Mudrick probably went through a standard due diligence process for a DIP loan. They looked at financials. They talked to management. They reviewed the market. But they apparently didn't account for the possibility that the financials were fabricated. This is a philosophical problem in capital allocation. You have to assume that some percentage of the information you receive is incomplete or inaccurate. You have to build in margin of safety. You have to be skeptical. The lenders took $1 billion position without that skepticism. The result is liquidation. Third, when a company can burn through $1 billion of fresh capital in 4 months and still fail, the underlying business model was never sound. The DIP loan was supposed to stabilize the company and buy time for restructuring or sales. It didn't. 4 months later, the company is liquidating. That's not because of lender mistakes or market conditions. That's because the business fundamentals were broken. The company couldn't survive even with $1 billion of fresh capital and the protection of bankruptcy. That tells you the business was probably already broken before it filed. The fraud just accelerated the inevitable. Here's my closing conviction. First Brands is not a unique story. It's a repeat of a pattern that happens in every economic cycle. A founder builds a company on unsustainable practices. The founder extracts cash for personal use. The accounting gets manipulated to cover it up. Eventually, the lenders figure it out. The company collapses. The lenders take a loss. The creditors lose. The employees lose. What's different about First Brands is how fast it happened. September to January. 4 months. $1 billion DIP loan that bought almost nothing. That velocity tells you the fraud was deep, the business was broken, and the reckoning was inevitable. The only surprising part was that it took Oaktree and Mudrick a whole month to figure out what was really going on. In a capital allocation context, that month cost them hundreds of millions of dollars. Here's the sentence you'll remember. When the first thing lenders do after putting in $1 billion is discover that the company's founders fabricated its revenue, that's not a bad loan. That's proof that the company should never have existed in the first place. Moving to next title, NVIDIA is investing $2 billion in CoreWeave for AI plants. NVIDIA just put $2 billion into CoreWeave. Not as a customer, not as a supplier relationship, as an investor. Jensen Huang, the CEO of NVIDIA, is putting NVIDIA's balance sheet behind a company that has only one real business model: rent access to NVIDIA chips using borrowed money, then hope the economics work out. This is a moment that reveals how capital allocation works at the absolute top of a market cycle. Let me explain what CoreWeave does, because it's important to understand exactly what NVIDIA is betting on. CoreWeave buys NVIDIA chips. It does this using high-interest debt. It then rents access to those chips to other AI companies and businesses. That's it. That's the model. You're essentially a middleman between NVIDIA's manufacturing and companies that want to use AI but don't want to buy the chips themselves. The margin in this business is the difference between what CoreWeave pays for capital and what it charges customers for access to the chips. It's a leverage play. It's a financing play. It works well when capital is cheap and demand for computing is unlimited. It works poorly when capital becomes expensive or demand softens. CoreWeave had a significant delay in one of its data center projects. That caused the stock to sink 30% since October. 30%. That's not a correction. That's a collapse. And just months later, NVIDIA is investing $2 billion to double down. Now think about what that signals. Either NVIDIA knows something that the market didn't know in October when CoreWeave fell 30%, or NVIDIA is willing to bet that the market was wrong. Or, and this is the uncomfortable possibility, NVIDIA is investing because NVIDIA needs CoreWeave to succeed, regardless of whether it's a good bet. Let me explain that last possibility first. Because it matters for capital allocation, NVIDIA sells chips. CoreWeave buys NVIDIA chips. If CoreWeave fails, NVIDIA loses a customer. Not just any customer, a customer that was going to be big. Michael Intrater, CoreWeave's CEO, said, "This expanded collaboration underscores the strength of demand we are seeing across our customer base, and the broader market signals as AI systems move into large-scale production." That sounds like demand is strong. But what if the demand is only strong if people can access cheap capital? What if the growth is only real if people can borrow at low rates to buy NVIDIA chips? When you're NVIDIA and you're forecasting massive continued growth, and one of your biggest potential customers is struggling with capital access, you have an incentive to solve that problem. You have an incentive to invest. You have an incentive to backstop their financing. Because if CoreWeave fails, it's not just losing a customer. It's a signal that the entire leverage-based cloud computing model might be broken. So NVIDIA is investing not just out of optimism. NVIDIA is investing because NVIDIA needs CoreWeave to work. That's a different kind of capital allocation decision. That's defensive. That's self-interested. Here's the specific structure of the deal. NVIDIA already owned a 6.6% stake in CoreWeave. Now NVIDIA is buying an additional $2 billion of stock, at $87.20 per share. That's a lot of capital. And NVIDIA said it would use its financial strength to help procure land and power for the projects. Translation? NVIDIA is not just investing in CoreWeave. NVIDIA is investing in the infrastructure around CoreWeave. NVIDIA is buying land. NVIDIA is securing power contracts. NVIDIA is removing the constraints that could slow CoreWeave down. This is NVIDIA acting as a vertically integrated investor. NVIDIA makes the chips. NVIDIA's customer uses the chips. If the infrastructure around that use case breaks, NVIDIA fixes it at their own cost. Now let me show you what the market did on screen. You're seeing CoreWeave's stock and bond prices respond to this news. CoreWeave's stock closed up 5.7% at $98.31 on Monday. That's the day NVIDIA announced the investment. Bond prices jumped more. The company's 9.25% bond due in 2030 climbed to about 98 cents on the dollar, up from 95 cents the week before. That's a 3% move in bond prices in a single week. Here's what that means. Investors in CoreWeave bonds were terrified. They were pricing in default risk. The bonds were trading at a discount because people were worried CoreWeave wouldn't survive. Then NVIDIA announced the investment, and suddenly investors said, okay, if NVIDIA believes in this company enough to put $2 billion in, maybe it survives. The bonds rallied 3%. That's the power of NVIDIA's balance sheet. It's not that NVIDIA convinced investors CoreWeave is fundamentally sound, it's that NVIDIA's willingness to invest reduced the probability that CoreWeave goes bankrupt. When NVIDIA is on the hook for land, power, and capital, CoreWeave is harder to kill. But here's what I want you to understand about the capital allocation decision itself. NVIDIA said its investment reflects confidence in CoreWeave's business, team, and growth strategy as a cloud platform built on NVIDIA infrastructure. But the core issue hasn't gone away. CoreWeave's business model depends on high leverage. CoreWeave's survival depends on continued access to cheap capital and continued demand from customers willing to rent chips instead of buy them. If capital becomes expensive, CoreWeave's economics break. If demand softens, CoreWeave's revenue drops, but their debt obligations don't. They still have to pay the high interest loans they took out to buy the chips. NVIDIA's investment doesn't solve that. It just means that if CoreWeave fails, NVIDIA is on the hook for some of the losses. It extends the runway, it reduces the immediate risk. But it doesn't change the fundamental model. Jensen Huang said AI is entering its next frontier and driving the largest infrastructure build-out in human history. That might be true, but infrastructure build-outs don't always work. The railroad industry built the largest infrastructure in history in the 1800s. Most railroad companies went bankrupt. The winners were the ones who survived the shakeout. The losers were the ones who took on too much debt, building infrastructure that didn't generate returns. CoreWeave is betting on being in the winning group. NVIDIA's $2 billion investment is a bet that CoreWeave will be in that group. But it's not a guarantee. Here's the reality that nobody wants to confront about this situation. NVIDIA's stock is down 0.6% on the news that NVIDIA is investing $2 billion. That's not positive. That's lukewarm. It's not even flat. It's down. On the day NVIDIA announces a major investment, NVIDIA shares decline. That's the market saying, we don't think this is a good use of NVIDIA's capital. But CoreWeave stock is up 5.7%. The market is saying CoreWeave is worth more because NVIDIA is standing behind it. The beneficiary of NVIDIA's capital is CoreWeave's shareholders, not NVIDIA's shareholders. That tells you everything about who's making the good capital allocation decision. CoreWeave investors are getting the upside. NVIDIA investors are getting a company that's putting $2 billion into an uncertain venture to rescue a troubled customer. Here's the reason this matters. When a company makes capital allocation decisions that benefit other stakeholders more than their own shareholders, that company is often near the peak of a cycle. NVIDIA has so much cash. NVIDIA has so much power in the market. NVIDIA can afford to make defensive investments that aren't purely about maximizing shareholder value. When companies have that kind of optionality, they often misuse it. Now let me extract 3 timeless lessons from NVIDIA's investment in CoreWeave. First, capital allocation decisions should not be driven by defensive motivations or the need to rescue a dependent business. If CoreWeave is only valuable because NVIDIA needs it to succeed, NVIDIA should probably not be investing. Good capital allocation is about investing in things that are valuable independent of your own business success. CoreWeave is valuable partly because the AI compute market is real and growing, but also partly because NVIDIA's customers need NVIDIA to help them finance and build the infrastructure to use NVIDIA chips. That's circular. That's not a good foundation for a $2 billion investment. Second, when the capital you're deploying benefits other stakeholders more than your own shareholders, you're probably making a mistake. CoreWeave's stock is up. CoreWeave's bonds are rallied. CoreWeave's shareholders are celebrating. NVIDIA's stock is down. That's not accidental. That's the market telling you that the investment benefits CoreWeave more than NVIDIA. Good capital allocation is about making decisions that benefit you more than the other party. If it's the opposite, you're probably overpaying or overcommitting. Third, leverage-based business models are only stable when capital is cheap and demand is unlimited. CoreWeave's entire model depends on those two things being true. If either one changes, the math breaks. NVIDIA's investment doesn't fix that. It just extends the runway. But a business model that requires continuously cheap capital and continuously growing demand is fragile. It's not a business. It's a bet on perpetual favorable conditions. When the conditions change, and they always do, the business breaks. Here's my closing conviction. Jensen Huang is one of the best capital allocators in tech. NVIDIA has generated enormous shareholder returns. But this investment feels different. This feels like a company with so much market power that it's starting to make defensive investments to protect its position. That's what happens near the end of cycles. The leader tries to lock in its position by investing in dependent companies. But those investments often destroy value, not create it. CoreWeave might succeed. The AI compute market might be huge. Infrastructure investments might make sense. But the fact that NVIDIA's stock is down on the announcement, while CoreWeave's stock is up, tells you that this is not a capital allocation decision that's primarily benefiting NVIDIA shareholders. This is NVIDIA using its capital to stabilize a dependent business. And when the best companies start doing that, it's usually a warning sign. Here's the sentence you'll remember. When a company becomes so dominant that it has to invest in its customers to keep them alive, it's not a sign of strength. It's a sign that the cycle is turning. Moving to next title, U.S. invests in rare earth firm. The U.S. government just wrote a $1.6 billion check to a rare earth mining company. Not a loan to a failing industry. Not a subsidy for agriculture, a $1.6 billion check to USA Rare Earth to build domestic capacity for critical minerals that, according to the government, the country can no longer buy from anyone else. This is capital allocation driven by geopolitical necessity, not by economic fundamentals. And it's a pattern we're going to see a lot more of. Let me explain what's happening and why it matters for how we think about capital allocation in the age of great power competition. USA Rare Earth is a rare earth metal producer. Rare earth metals are elements like neodymium, dysprosium, and praseodymium. They're not used to make rare things. They're used to make modern things. Electric motors, permanent magnets, semiconductor manufacturing, defense systems. Without rare earths, you can't build anything sophisticated. For decades, the U.S. didn't care about rare earth supply. China had them. China was willing to sell them. China had the cheapest labor and the worst environmental regulations, so China dominated the market. American companies bought from China. Problem solved. Then China changed the equation. In April of last year, China restricted its rare earth exports. Not banned, restricted. But that restriction was enough to force a reckoning. The United States had become completely dependent on a single country for materials essential to national security. That's the moment everything changed. That's the moment the U.S. government realized that leaving rare earth supply to market forces was a luxury the country could no longer afford. Enter Barbara Humpton, CEO of USA Rare Earth. She's the builder. She's the allocator. She's the leader who recognized that her company could become a national asset if the incentive structure changed. The capital structure is fascinating. The Commerce Department offered a non-binding letter of intent for $1.3 billion in senior secured loans, plus $277 million in direct federal funding. That's $1.577 billion in government money. But that's not all. USA Rare Earth also raised $1.5 billion in private investment, anchored by Inflection Point. That's a venture capital firm. So you have $2,077 million in government capital, plus $1,500 million in private capital. Total, about $3.5 billion in fresh funding. But here's the key detail that tells you everything about how this works. The government gets equity for its investment. The Commerce Department will receive 16.1 million shares and 17.6 million warrants. That means the government is not just making a loan. The government is taking an ownership stake. The government is betting alongside the private sector. This is fundamentally different from traditional subsidies or loans. This is the government acting like a venture investor. The government is taking equity risk. The government's return depends on USA Rare Earth becoming successful and valuable. That changes the incentive structure. When the government just gives money as a subsidy, the company doesn't have to succeed. The money is free. But when the government takes equity, the government has an incentive to monitor, to push for efficiency, to demand returns. The government becomes a shareholder with skin in the game. Barbara Humpton said, "With this unprecedented show of public and private support for our company, we are positioned to accelerate the build-out of important domestic capabilities that are essential to U.S. national security, global economic competitiveness, and critical technologies of the future." That's the pitch. That's what Humpton is telling shareholders and investors. The government believes in us. The government is backing us. We're going to build something transformative. Commerce Secretary Howard Lutnick said, USA Rare Earth's heavy critical minerals project is essential to restoring U.S. critical mineral independence. This investment ensures our supply chains are resilient and no longer reliant on foreign nations. But here's where I want you to focus on what's really happening. The government is not investing in USA Rare Earth because USA Rare Earth has a great business model or fantastic unit economics. The government is investing because the alternative, continued dependence on China, is strategically unacceptable. This is capital allocation driven by geopolitical constraint, not by profit motive. Now look at the numbers. USA Rare Earth issued preliminary results for 2025. The company expects to report operating expenses and operating loss between $56 million and $62 million for the year. That's a loss. That's not a profitable company. That's a company that's spending more money than it's making. And that's before the capital infusion. Now, USA Rare Earth is going to spend billions building out domestic rare earth capacity. Those losses are going to expand before they shrink. The company is going to burn through cash as it scales. The government knows this. The government is okay with this. Because the government's incentive is not to maximize returns on capital. The government's incentive is to ensure supply security. If USA Rare Earth loses money for the next 5 years while it builds capacity, the government considers that a success, not a failure. Here's the pattern that emerges. When the government becomes a capital allocator based on strategic necessity rather than economic return, the rules change. Companies can sustain losses that would destroy private companies. Companies can invest in capacity that private markets would never fund. Companies can prioritize national interest over profitability. Now, let me show you what the stock market did. On screen, you're seeing USA Rare Earth's share price move on the announcement. The stock rose 8.1% to $26.77 on Monday, the day the government announced the funding deal. That's interesting. That's not a massive move. That's not, oh my God, we're going to be a national champion territory. That's a modest single-digit pop. It tells you that investors were somewhat expecting this. Or it tells you that investors understand something about the underlying business that makes them skeptical about the long-term value creation. Think about it this way. If the government is funding USA Rare Earth so heavily, and USA Rare Earth still can't be profitable in 2025, how is USA Rare Earth ever going to generate returns that justify the investment? Either USA Rare Earth's business model is broken, or the government's capital infusion is so large that it's going to take years of success to justify it. The stock moved up 8%, but if you look at the 3-month performance chart that's on screen, you can see the trajectory since November. USA Rare Earth stock has moved around. It's not a one-way up. It's not a rocket ship. It's a company that investors are betting on, but cautiously. Here's the uncomfortable truth about government capital allocation. The government can invest in things that the private sector won't fund. The government can pursue long-term strategic goals that ignore short-term profitability. But the government is not necessarily good at capital allocation. The government's incentives are different from a private investor's. The government's time horizon is political, not economic. The government's risk tolerance is based on national security, not returns. This is not to say the investment is wrong. It's to say that the investment is being made in a different framework than private capital investment. The government is accepting losses that would be unacceptable in private markets, because the alternative, being dependent on China for rare earths, is strategically unacceptable. The broader pattern is that as geopolitical competition intensifies, you're going to see more government capital allocation like this. The government is going to invest in semiconductor manufacturing. The government is going to invest in battery supply chains. The government is going to invest in biotech. The government is going to subsidize production costs and guarantee margins, because the alternative is falling behind competitors. This is the emergence of a new paradigm: government-backed strategic industries in competition with each other across borders. It's not capitalism. It's not socialism. It's something different. It's industrial policy driven by geopolitical necessity. Now let me extract 3 timeless lessons from what's happening with USA Rare Earth. First, when capital allocation is driven by strategic necessity rather than economic return, the traditional rules of business break down. USA Rare Earth is losing $56 to $62 million a year, and the government is investing $1.6 billion anyway. In traditional private equity, you don't invest in companies that are burning cash without a clear path to profitability. But when the alternative is strategic vulnerability, the government accepts that. The lesson is: understand what drives the capital allocation decision. If it's economics, apply normal business analysis. If it's strategy, apply geopolitical analysis. They're different frameworks. Second, when the government becomes a major shareholder, the incentive structure of the company changes in ways that are hard to predict. The government is taking equity in USA Rare Earth. The government has voting rights. The government has warrants. The government's priority is not maximum return on capital. The government's priority is supply security. That creates potential conflicts with private shareholders who do want maximum return on capital. When public and private investors have different incentives, things get complicated. Third, the beginning of capital allocation driven by geopolitical competition is recognizable by what gets funded regardless of profitability. USA Rare Earth is losing money, but it's getting $1.6 billion. That's not the private market at work. That's the government solving a strategic problem. This pattern is going to proliferate. Semiconductors, batteries, biotech, anything related to advanced technology. The government is going to ensure domestic supply by subsidizing companies that wouldn't be viable otherwise. The stock market is going to trade on those stocks, understanding this dynamic, not based on earnings, but based on the government's commitment to the strategic objective. Here's my closing conviction. USA Rare Earth is not a company. It's a national project wearing a company's clothes. It's going to get funded. It's going to build capacity. It's probably going to lose money for years. And that's fine from the government's perspective, because the government's objective is not to make a return on capital. The government's objective is to ensure that the United States can manufacture the rare earth elements it needs, without depending on anyone else. The question for investors is, are you betting on USA Rare Earth as a profitable company, or are you betting on the government's commitment to ensure supply security? If it's the former, you're probably going to be disappointed. If it's the latter, you're probably going to be fine. The stock will trade on the government's capacity to keep funding the project, not on actual business fundamentals. Here's the sentence you'll remember. When the government becomes a capital allocator driven by geopolitical necessity, profitability becomes optional and strategic control becomes essential. Now, towards last article, wait list for Birkin or Rolex gets shorter. The wait list for a Hermes Birkin bag is shrinking. For years, that wait list was the golden ticket of luxury retail. The wait list meant scarcity. Scarcity meant exclusivity. Exclusivity meant everyone wanted one. Now the wait list is disappearing. And that's telling you something profound about how capital allocation works in luxury markets. Let me explain what changed and why it matters. Ferrari and Hermes have built some of the greatest wealth creation engines in business history. Both delivered total shareholder returns of close to 700% over the past decade. For comparison, Gucci's owner Kering managed just 140%. Ferrari and Hermes crushed the market. And they did it using the same strategy: scarcity. Here's how it works. Ferrari makes fewer than 15,000 cars a year. Porsche makes more than 300,000. Yet Ferrari's market capitalization is $59.6 billion, while Porsche's is $45.4 billion. Ferrari makes one car for every 27 cars Porsche makes, but Ferrari is worth more. That's the scarcity premium. How does that happen? By starving the market of supply and catering only to the super-rich, Ferrari can charge millions of dollars for limited edition cars. Porsche has to sell in much larger quantities at lower prices. Same industry, completely different economics. The difference is scarcity. Patek Philippe is a privately held Swiss company that makes 72,000 watches a year. Cartier, which is owned by Richemont, makes almost 10 times as many. Yet Patek Philippe watches fetch an 11% premium to their original price when resold. Cartier watches resell for a 31% discount. The wait time for a new Patek can stretch to years for the Nautilus and Aqua Martin models. People are willing to pay premiums today to avoid waiting years for the privilege of buying at retail tomorrow. Hermès makes roughly 150,000 Birkin & Kelly handbags per year, but here's the hidden leverage. Those 150,000 bags drive approximately 25% of Hermès's overall company sales. Why? Because of a practice called bundling. To buy a Birkin, you have to spend thousands of dollars on other Hermès goods, clothes, furniture, accessories. The handbag creates demand across the entire category. This is genius capital allocation. The company produces only what people desperately want. That desperation spills over into every other category. A customer who can't get a Birkin buys Hermès silk scarves instead. Hermès perfume, Hermès watches, Hermès everything. The scarcity of the Birkin drives sales across the entire business. The business model has been so powerful that Hermès's annual advertising spend is only 4% of total sales. Most companies spend 10% or more. Hermès doesn't need advertising. The scarcity creates the demand. The secondhand market does the advertising. When you see that a Birkin holds its value or appreciates, that reinforces the hype. The brand does the marketing work for Hermès. This is a business where incentives are perfectly aligned. Artificial scarcity creates authentic demand. The demand spills over across categories. The brand generates its own marketing through resale value. Margins are enormous. Growth is controlled. The waiting list smooths out sales across economic cycles. For a decade, this has been the best performing strategy in luxury. Ferrari and Hermès are living proof. But something is breaking now, and you can see it on screen. Look at the resale premium data. I'm going to walk you through what these numbers mean, because they tell you everything about where demand actually is. Patek Philippe watches used to resell for an average 38% premium to retail. That was 3 years ago. Now, they're at 11%. That's a collapse. Rolex used to fetch around 17% premiums. Now it's at 7%. Roughly halved in 1 year. This is recent. This is happening right now. Hermès Birkin & Kelly bags are at their lowest resale premium since 2017. The bags now resell for 50% above retail prices. That sounds impressive, but here's the reality check. Strip out the popular Mini Kelly, which flatters the average, and the larger versions of the Birkin & Kelly bags sell at par to retail prices once you factor in the auctioneer's commission. They're not holding their value anymore. They're holding their price, but not their value. Luca Salka is a Bernstein luxury analyst. He said, current resale premiums seem to suggest that waiting lists have shortened and that the total supply for Hermès's bags is now closer to demand than before. That's the diagnosis in one sentence. The wait list is disappearing. Supply is becoming closer to demand. The scarcity premium is eroding. What happened? A few things. First, the market is returning to normal after speculators sent prices through the roof during the pandemic. The pandemic created artificial demand. Bored rich people stuck at home. Low interest rates. No place to travel. They bought watches and handbags. Those speculators are now liquidating. They bought at peak prices. They're selling to get cash. That adds supply to the secondhand market, which pressures prices. Second, primary market prices are increasing faster than people's willingness to pay. Patek Philippe raised prices 22% last year in the US, partly because of tariffs, but secondhand prices aren't keeping pace. When primary market prices jump, but secondary market values don't follow, the resale premium shrinks. You're paying more at retail, but the watch is worth less when you try to sell it. That's the opposite of the scarcity narrative. That's the signal that demand is weakening relative to supply. Third, and most importantly, Hermès' non-handbag categories are weakening. In the third quarter, the leather goods division grew 13%, but sales of watches and perfume declined from a year ago. The bundling is breaking. People aren't forced to buy the other stuff to get the Birkin anymore, because the Birkin is becoming available. And when they don't have to buy the other stuff, they're not buying it. This is the moment when the scarcity model breaks. Not because scarcity stopped working, but because scarcity created so much perceived value that brands raised prices. And when brands raise prices too much, the value proposition breaks. People decide, maybe I don't need a Patek Philippe that costs $100,000 more than an Omega. Maybe I don't need a Birkin if I have to spend $20,000 on other Hermès goods to qualify. The business model contained the seeds of its own destruction. By creating artificial scarcity and charging premium prices, the brands made themselves too expensive relative to the alternatives. And now demand is normalizing. Here's the economic reality. The scarcity model only works if you can sustain the illusion that supply is constrained by genuine capacity limitations rather than deliberate choice. David Dubois is an associate professor of marketing at INSEAD. He said, "Scarcity works only when customers believe that tight supply is the result of genuine capacity constraints. Each Hermès Birkin is hand-stitched by a single leather worker. That's a genuine constraint. Patek Philippe actually could make more watches, but chooses not to. Ferrari actually could make more cars, but chooses not to. The question is, can they maintain the illusion that the constraint is real? When brands start raising prices dramatically, when Patek raises prices 22% in 1 year, customers start wondering, are you really constrained? Or are you just raising prices because you know we'll pay? Once that doubt enters the customer's mind, the premium starts eroding. Ferrari has one additional check on this. Ferrari carefully allocates its most coveted cars based on criteria including how many Ferraris the buyer already owns. A collector had to buy an average of 10 Ferraris before qualifying for a LaFerrari or an Icona. Ferrari is literally controlling who gets access, not just limiting supply. Patek Philippe has a similar system. To get the most coveted watches, you have to write a letter to the CEO, laying out which Pateks you already own, and whether you've sold any. If you're new, you don't get access to the best pieces. This is capital allocation at its most sophisticated, controlling not just how much you make, but who you're willing to sell to. The goal is to preserve the brand narrative. If too many people own the watch, the prestige declines. But here's what those wait lists used to do. They made everyone feel like they were missing out on something real. The wait meant it was genuinely scarce. Now, the wait is disappearing. And that changes everything. On screen, you're seeing the Hermès Birkin resale premium chart over the past decade. The chart shows the premium climbing through 2015, 2016, 2017, peaking around 2018-2019, then staying elevated through the pandemic boom. Now in 2026, the premium is rolling over. It's coming back down to levels last seen almost a decade ago. That line is the story. That's the scarcity premium evaporating in real time. Let me extract 3 timeless lessons from the collapse of the luxury scarcity model. First, when artificial scarcity is sustained by price increases rather than genuine constraint, the model breaks. Ferrari limits production because Ferrari physically can't make more cars and maintain quality. Patek Philippe limits production because it wants to. But when Patek raises prices 22% in 1 year, customers start asking, which is it? The scarcity only works if customers believe it's about supply, not price. Once they suspect it's about price, they're willing to look elsewhere. The moment scarcity depends on customer belief rather than customer constraint, the model is fragile. Second, spillover demand is only sustainable if the primary constraint remains credible. Hermès uses the Birkin to drive sales across the entire company. That works brilliantly, as long as customers believe they need to buy the other stuff to qualify for the Birkin. But the moment supply normalizes and the waitlist disappears, the spillover demand vanishes. People no longer feel forced to buy the scarves and perfume and furniture. They realize they didn't actually want those things. They just wanted access to the Birkin. When the primary scarcity breaks, the secondary demand collapses with it. That's catastrophic for a model that depends on spillover revenue being 25% of total sales. Third, success in the scarcity model plants the seeds of failure because it encourages price increases that eventually break credibility. Ferrari and Hermes were so successful at commanding premium prices that they kept raising them. That success attracted speculators during the pandemic. Prices got bid up to unsustainable levels. Now the market is returning to normal. The resale premiums are collapsing. The scarcity model works great until it works too well. Then it breaks. Here's my closing conviction. The scarcity model in luxury will survive. Hermes will keep selling bags at premium prices. Ferrari will keep making limited cars. Patek Philippe will keep controlling allocation. But the old dynamic, where scarcity itself created value and collectors would pay any premium to participate, that's gone. Demand is normalizing. Prices are adjusting. The brands are discovering that when you raise prices enough, people stop believing in the scarcity and start looking for alternatives. The great luxury story of the past decade was, buy the scarce stuff, because scarcity is forever. The luxury story of the next decade is, buy the scarce stuff at reasonable prices, but be skeptical of the brands that keep raising prices to maintain margins. The companies that win are the ones that understand. The scarcity premium is real, but it's delicate. It depends on customer belief. And belief can evaporate faster than any premium when the price gets too high. Here's the sentence you'll remember for years. When artificial scarcity depends entirely on customer belief in supply constraints, raising prices is how you destroy the belief. This is Avi. Like and subscribe. On to the next.